we are going to look on how we end up, or how do we manage to book a transaction in a Oracle system, and the features or aspect or the setups that are important and they need to be in place before we can be able to book a transaction. So today it's all about transaction, because all this training we are learning is all about how to manage the data, and those data are the ones that are booked or are maintained or are keyed in the system as transactions. So if I can give you a simple scenario, let's say you want to buy an iPad. And maybe that iPad, you have purchased it for maybe, let's say, 1,000 Kenya shillings or even USD. So do you think this information is important or is enough to book a transaction in a system?
The
information that I've provided, that you are purchasing an iPad, and there is a figure of 1,000 showing next to that iPad.
But you're the one purchasing. The company is the one purchasing.
Yeah, anyone, and they tell you to book that transaction in the system. Do you think it's enough to book in the system?
No.
What do you think could be missing?
Maybe more details like a model, the invoice number, if yeah, purchasing.
Okay. Yeah, so what happens is that when you are doing a transaction, or when you're booking a transaction on, or when we buy something, there is some information that is very key when it comes to purchasing an item and recording it. And through that information, we can be able to look and see what are the basic information we may need so as to be able to book a transaction in a Oracle financial system. And one of the things we need is, or you might find, is that you may need to know when the item was purchased. So there is an aspect of date. There is an aspect of date. Maybe you purchased that item today, which is 11th of August, 2023. So date is very important when you are purchasing, because through the date is what will tell us when exactly did that transaction occurred, and how can it be traced. It's only through the date that you start to track a transaction when it occurred, when it needs to be booked. So a date is very important when it comes to booking a transaction. And now in Oracle financials, what happened is that we need a calendar so as to be able to have a date, or to be able to use a date aspect in transaction booking. So we usually need a calendar, and this calendar, to have it, it has to be some few aspect has to be considered. And one of the aspect is the country. For you to understand about this, different countries maintain different financial years. Okay. So this one call it country. So for example, in Kenya, do you know the government financial year? When does it start and when does it end?
July 1st to June 30th.
Good. So for example, the current year for the government has started on July 1st, 2023, and it shall end on 30th June 2024. Okay. Then in a country like USA, do you have an idea when the year starts and when it ends?
Nope. Nope, I have no idea.
So in a country like USA, the year starts, the calendar year or the year starts, or the government year starts on January, 1st of January, for example, 2023 to 31st December 2023. So these years or these calendars have some kind of differences. You see, there's one that is starting in between, in the middle of the year, and there's another one starts at the beginning of the year. So in the system or in Oracle systems, for you to be able to have a calendar that will make you able to book a transaction so that you can provide, through providing a date, you need to understand that we have two different types of year or year types. Excuse me. So the year that starts in the beginning or starts in one year and ends in another year, in the Oracle financial systems, we call it fiscal year. Then the year that starts on January and ends in December, we refer to it as calendar year. So date, it's very much important, but we cannot have a date without a calendar in the system. Okay. And we cannot have a calendar without having identified the year type that we need to use so that we can create a calendar in the system. So this one, we call them year types. We have only two year types. And as a functional consultant, you will need to create a calendar before you can create a transaction in the system. So calendar is very important, but you don't just create a calendar like that. You have to understand, like, we have two types of year types. So if you are implementing a system, like for example, in Kenya, and you are using or you're implementing for an organization that follows government financial year, you will use the fiscal year because the government financial year starts on 1st of July 2023 and ends in the next year. That will be 30th of June 2024. So that's very key for you to be able to create a calendar. You have to understand you have year types. Okay. Any question?
No.
Then, through creating a calendar, there is information that we provide. We provide the period names. So there are periods that we usually use when creating a calendar. And normally we usually, or most of the time you might find, periods are maintained in a range of a period of 30 days. And that's like a month. And also there are some periods which are maintained, for example, call them period types. You might find there are periods which are daily and monthly. So for us to create a calendar, we need a period or periods. Okay. And periods, you'll find you have to create them as you create the calendar. But you have to identify what period types are you using when you're creating the period types. So you have to select a period type when creating a calendar so that you can be able to specify that your calendar has a nature of what type of periods. And when it comes to period, you'll find, for example, you might find there is a period of like 1 year. There's a period of 6 months. There's a period of 3 months. There's a period of 1 month. There's a period of 1 day. So basically, most what is used in many organizations, it's a period of monthly period, because that's when that's the nature of how they estimate the amount of transaction they have been doing, the business they've been conducting, and at that end they can comfortably report a certain kind of business transaction under that kind of period. So when it comes to creating of periods, for example, we can say a period will start, usually name it like, for example, if for example, you are using the Kenyan physical year, whereby you will be using the year will be starting on 1st of July each and every year, you can say that the first period will be July 2023. Okay, it will be July 2023, and you will provide when it starts, that is 001 July 2023, and it ends on 31st July 2023. So normally you have to provide a range of that period. So if it's for example, a daily period, you will say, for example, if it's today is on 11th, you can say it is 11th July, 11th of July, and 11th of July starts on 11th of July 2023, and it ends at 11th of July 2023. Do you understand those terms and the aspect that I'm trying to explain?
Yes, I'm understanding them. So the dates, is it like for every transaction you have to create a calendar, or it's a configuration thing?
It's a configuration thing. That's a good question. Once you create a calendar, when you are doing implementation, you only create it once. You only create it once. What you will be creating additionally is periods. You will be adding periods. Like, for example, if you have created from January 2023 to December 2023, you will need to add other periods for January 2024 to December 2024. So periods are the ones that you'll be adding. Okay.
And
but
you can add as many periods.
Yeah, you see
Maybe
period.
like
You see, it's all about how the life of the company continues to be. If there is a going concern, of course, you have to create periods for you to be able to book transaction in those future periods.
Okay.
Have I answered your question? For example, if it's on deck 2023 and you will continue doing business in 2024, of course, you need to create periods for 2024.
Okay.
Does it make sense?
Yeah. No, you gave an example of like a daily period, like
Yes,
something that every day.
exactly.
So
And your voice is breaking. Could you put your mic near?
sorry. Or I think my question was, when you said okay, you find in a company there's and some things a company does monthly, like maybe reconciliation. Some things are biannually, like maybe paying of dividends.
Yes.
So are you saying every time maybe I want to book a transaction in the system, I set a calendar for that?
Not every time you are booking a transaction. What usually happens when you're doing implementation of a system or of a new system in an organization that has never been using the system, you will need to create a calendar. And that calendar, under that calendar, it has periods. So those periods, what happens is that you will need to open and close those periods. For example, if it's in a situation where you have created a calendar that starts on January to December, if you are in January, the best practice is that you should open. Okay, I had not mentioned this. Periods, there is a function whereby you can be able to open a period, meaning you can be able to make that period accessible to book a transaction. What does that mean? If, for example, if it is on the period of January 2023 and you have not opened that period, there's a feature for opening and closing in all modules. For example, you remember I showed you the module for finance. In all modules, you can be able to close a period and open a period. So the best practice is at each and every period of your organization accounting. For example, if it's monthly, the finance team should be able to do all the procedures of closing these periods. There are procedures you will come to learn later. But the important thing you are supposed to understand here is that the reason why this period is important is because as an organization, there are times whereby to control fraud and all those bad practices, you will need to have a control, or the Oracle Financials has a feature of control whereby you can close and open periods. So if it's January 2023 and you have opened that period, It means anyone can go into the system if they have access through the responsibility of whichever module they are using. They can go in the system and book a transaction in any of the dates in that period of January. So your question was about the daily periods, whether you will be or creating periods each and every time you are booking a transaction. No, a period, the system is created in a way that it has all these calendars in it, or it has all the days of a calendar in it. So what you usually do is to do the setup. Once you have done the setup, you can now be able to allocate that setup to each and every period and module. So when you're booking a transaction, if you are the chief accounts payable officer, you can be given an assignment that you are the one who will be opening and closing the periods for control purposes. So unless a period has been opened, you cannot book a transaction in it. So what happens? For example, the reason why I put this one for daily here is because we have organization like financial organization, like banks. Banks, they close their books daily. They close their book daily, and that's why you'll find they will have to do all the balancing in one day. So their transaction has to be balanced in a daily, and they close books for that day. Then, if, for example, they are using Oracle Financials, the person who has been given the mandate to open and close period, they have to make sure that they close that day's period. If it's, for example, today is the 11th of August. The person who have been given the mandate to open and close the period, they will make sure that they have closed the books, the periods for today, that if there is any transaction has not been booked in the system for today, it will not be booked. So everything has to be done efficiently. So that's the key important of understanding how the periods work. So, but now we cannot have the periods without the calendar, and we cannot have the calendar without the periods. So without the periods, without opening the periods, you cannot be able to select this date or book a transaction in this date. The moment you go and try to book, it will tell you that periods for the date you are trying to book a transaction are not opened. So the calendar is very important. You can see under the calendar, that's where we are having a period, for example, January 1st to January 31st, July 1st to July 31st. Is it clear?
Yeah.
Yeah, so this one we call it date. Date is very important. You cannot book a transaction without the date. Then the iPad, this call it description. Description, huh? And the description, then we have, what do you call this?
The price.
Why do you think it's a price? It's just a figure.
I'm not sure it's a price. Now that you've asked. It could
How do
be
you
the
think
amount.
it's the price? Okay, I can tell you are relating to the fact that you are booking a transaction. It could be the price for the iPad, but they could be also quantity for the iPad.
Yeah.
Isn't it?
Yeah.
It could be quantity. So that's all about the date. And then now the next thing I want to talk about is, because you have mentioned that this could be the price, let me talk about the currency. Let's say, for example, we bought them in USD. And let me talk about the currency before I talk about the description. So in Oracle Financials or in Oracle applications, we have several types of currency or currencies. So one is functional currency. We have foreign currency, and we have static currency. So to explain this to you, functional currency. If, for example, you are implementing a system in Kenya, okay?
Yeah.
The functional currency can be Kenya shillings, okay? But still, you can be implementing a system in Kenya and you are not operating only with Kenyan shillings. You have other countries' currencies like USD. For example, in this case here up. So you'll need to book, you'll receive, for example, if you bought iPad from a company that's you have to pay them through the USD. You'll need to book this transaction in your system through the USD currency. So when you're booking this transaction in USD currency, and your organization usually use functional currency as Kenya shillings, and the other point is that in Kenya shilling is the local currency. Okay. Kenya shillings is local currency in Kenya. You need to understand that we refer to any other currency that you are not using as a functional currency. The functional currency is the currency that you use to provide or to give reports in your organization. It's a currency you use to, is the main currency that you usually report with in your organization. So what happens is that you'll book this transaction in USD, meaning that you have booked it in foreign currency. So foreign currency is any other currency that is not used in that country. It's not the local currency of that country, and it's not the functional currency of that country. Am I making myself clear?
Yes.
It's very important because transaction you can't book without providing currency. These three items I'm talking about here, they are the one we usually, they are primarily the ones that you'll be using to book a transaction. Any question about these currencies?
No. You've not mentioned this third one.
Before we go to the third one.
Also, does it mean like is using the transactions are in Kenya shillings, and they purchase something that's maybe it's in USD or a service that's in USD. Does that mean like the system can use both currencies?
Yes, you're very right. The system has all the currencies of the world.
Mhm.
Okay.
So how will it?
Sorry? Come up again.
Or maybe we're thinking like maybe they get something that that's in USD and it uses normally it uses Kenya shillings to record its stuff in the ledger. Then it you make a transaction through USD. So maybe how will it report that in like the financial statements?
So the system also has a feature we call the exchange rate. You can be able to provide the exchange rate in the system and convert the USD to Kenya shillings. Have I answered your question? Sorry?
Yes, it's clear.
Good. So I have a question. If we are booking a transaction in USA, okay? Kenya shillings here will be what type of currency?
It will be the foreign.
Good. What about the, for example, maybe something like Namibian dollar?
It
Will be?
it's foreign.
Yeah, it will be
If you're
foreign.
using,
What about USD?
it will be the functional currency.
We can say this is local currency, but if they are using any of these transactions to do their reporting, is their main reporting currency. That one is what we refer to as what? As functional currency. Is it clear?
Yeah. The example you've given, it's they're booking a transaction in USD.
Mm-hmm.
So that means it's the local currency at that time, but it's not functional currency.
If they are not reporting, their main reporting is not USD. USD to them is a local currency, but not their functional currency.
I've got it.
You got it, huh?
Yeah.
So this one, we can say it's our currency. And currency is very, very much important in booking a transaction. So when it comes to stat currency is something like any figure that is used to do statistical arithmetics. We usually use it not normally in our booking of transaction, but you'll find it has a relevancy in some areas. For example, if you are you are booking a transaction that doesn't have these other main currencies, but it has arithmetical calculation. For example, if you are giving like 100 marks, okay? So 100 marks, you can refer them to as statistical or static currency. But normally we don't use it mostly in this in Oracle transaction booking. So this is just for your information that you, in one way or the other, you might find it when you are working with Oracle currency or currencies. Okay. Is it clear?
Clear.
Good. So we go to the third one, the third item, which we call description. Under description, assume we have an organization that probably we have a company that is dealing with fuel distribution. We have a company that deals with electronic. We have a company that deals with software development. So normally what will happen is that we have a company and we have also branches or departments. For example, the way we are looking at some of our financial departments. But now, apart from financial department, we have a department like sales. Okay, we have department like inventory. We have department like research and development. We have a department for finance. We have a department for manufacturing. Okay. So normally what happens under this department, we also have type of accounts. For example, you can have you can say like, for example, there is a software sales. We have software sales. We have software expenses. We have salaries. We have electric, or call them utilities. You have rent income. We have rent expenses, and so on and so on. So what am I trying to explain is that we have this branch of our companies. Let's say, for example, we have company. Our company is ABC Group. Okay. And through ABC Group, it has registered different companies based on what they are doing business with, or they are trying to sell, or they usually sell. So company that do the distribution of fuel, it will maybe probably do a transaction under the Department of Inventory, it will pay what? Salaries. So this one in the Oracle system, we call them companies. You can call them even units or branches or plants. This one, we call them departments. These ones, we call them accounts. So the reason why these three are important is because under this company that distribute fuel, it has a inventory department, probably where they manage the storage of fuel, because fuel it's a tangible item, so it might be managed through inventory. And through inventory, there are salaries that may need to be paid. There are utilities, or maybe they have even rented the place where they store that fuel. So what happens is, for us to be able to book a transaction showing how this expense was incurred, we usually need to know that under ABC, which specific company incurred or has relation to that transaction. So for example, if it's fuel, you will come and say, under fuel company, we have a department of inventory that has incurred salaries expense. Am I making myself clear? So you can have also electronics. Under electronics, we have sales department that may be incurred some sales expense under the software. Okay. So this is for purpose of tracking this transaction, who triggered it to happen, because we will be reporting probably in the level of ABC group, but ABC group needs to understand which company under all the companies that it has incurred what, and how can we track it. So in the system, we have a way of capturing these three companies and department and accounts. So through this structure of capturing this transaction, we can be able to track the transaction to whoever initiated it and whoever incurred it, and which department, which company can or is incurring what. So for example, say like the company for electronics, they purchased what? They purchased 100 iPads. And those iPads costed 100,000. So you'll find we will need to say in description, we will need to provide that information that company electronics under the Department of Manufacturing, they were able to buy, maybe for example, some I'll call them iPads. So under the account segment, we will have iPads as an account. iPad purchase, or call them assets. So the description for this, you can be able to track these iPads, 100 of them, to see where they were purchased, or to see where you can be able to track them. You can be able, through the description, having combined all these three: company, department, and accounts, you can be able to track the iPads. But now what happens in the system, if the system has given us the capability of using numbers or figures. So you can say company 1 is 1, company 2 is 2, and company 3 is 3. Then we have department 1, we have department 2, we have department 3, department 4, department 5, and so on. The same case, we have account 1, we have account 2, we have account 3, we have account 4, we have account 5, we have account 6, and so on and so on. So what happens is, in the system, you can just go ahead and say electronics has number 1. So you can be able to book it as 1. I mean, electronics has 2. Then sales has 1. Then software has 2. So in the system, with this, you can have this combination of these segments to be able to, of these 3 items, that is company, department, and account, to be able to book a transaction. This will help in tracking the expense or the source of revenue. If it's a revenue that is coming in, it could be a sales. So you can be able to say, for example, electronics. No, this one was manufacturing. You're not telling me. So manufacturing here should be the second. For under department, we should be having 5. And under account, we should be having 7, because we purchased iPads, this one. So you can be able to track using these numbers instead of maintaining the names. Okay. So in the system, you will be able to see how we create these numbers with these names and provide a clear way of capturing a transaction without providing all these names. We just provide the numbers, combination of these numbers. So here we will, it could be 2.5.7. And this one, we will have to come and provide the currency. For example, if it is USD. So with the combination of date, for example, we say we purchased on 11th of August 2023. With the combination of this date and the combination of the description, we can be able to record, and the combination of currency and amount, of course, the amount has to go hand in hand with the currency. We can be able to book a transaction in the system. There is somewhere we are heading with this explanation. But the reason why I'm explaining you this is for you to see the importance of description. The description is formed by combining the company, department, and accounts. So these ones in Oracle accounts or financials, we call them segments. Okay. Then this one here down in Oracle accounts, financials, or in Oracle financials, we call them segment values. These you'll be working with them now and then, but usually configure them once, especially companies and departments, when there is a need. If you have a new department, you'll come and create a new department. But rarely you'll find companies are opening new department in very regular or in a very soon time when they open the last one. So it is important you understand that these three, we have to map them in the system so that we can be able to create, if for example is a company has more than one company, we'll create all those companies here, maintain them here. Then we'll need to maintain all the departments that they work with or they have in the organization. Then we'll create accounts. Accounts, these two, the first two, the companies and departments, might not be that much. But accounts can go to 1,000 because in an organization you'll find a lot of accounts that are transacting. Something maybe it's being paid, it needs to be tracked with its own account. It has to be created. So normally what happens, accounts are the most which are created in most of the time. So you'll find as a maybe general accountant or the chief financial officer will be the one who has maybe assigned the mandate to create new accounts in the system. But that's not the important thing. For now, what you need to understand is that we need to have these kind of features having created in Oracle system so that you can be able to manage or track your companies, your departments, and your accounts so that you can be able to tell a certain account was incurred some transaction under a certain department and under a certain company. Then you can be able to report generally for ABC group. So having noted that, for us to be able to create segments and segment values, there is a feature that we have to use. There is a feature that we have to use, and we call that feature accounts key flex field. And accounts, through accounts key flex field, we can be able to create segments, and under segments, these are the segments. They are the ones that we start with. We can be able to create the segments. Then under segment, you can be able to create the segment value. All these are segment values. These are segment values. All these are segment values. So we call them account segment value, department segment values, and then company segment values. Under which responsibility do we do this? We do this under the responsibility called a general ledger. General ledger responsibility. And then something else that I was almost to skip is called organization structure. So through account key flex field, we can be able to create organization structure. And what is organization structure is nothing else rather than the name of the company. So the organization structure is the name of the company. So we usually provide the name of the company as the organization structure. That's what we refer to as the organization structure. So these three give them a different picture. So these three, we can be able to create them under accounting key flex field, or through the feature we call accounts key flex field, and under the responsibility we call the general ledger responsibility. Is it clear?
Yeah, it's clear.
Once we've been able to create all this, okay? Once we've been able to create all this, we call it in one name as chart of accounts. COA. Are you able to hear me?
I can hear you.
Good. So this is chart of accounts. So through chart of accounts, we can be able to, just a minute, I connect something on power. Okay, so sorry for that. We are talking about the chart of accounts. Through accounts key flex field, we can be able to create organization structure, create segment values, and the combination of these three, we refer to it as chart of account. Are we together? So if you can be able to see, the description has taken us to all the way to something we have ended up with called chart of accounts. That explanation, we were heading to chart of accounts. But still, this is not the end of it. At least we now know the importance of description, don't we?
We do.
Good. So from what we've been looking at, we have 3 items that we've been looking at. The first one was
Date.
under date. What
and
was
that?
the main thing?
Calendar. Creating a calendar.
Yes. And this one, we don't just call it a calendar. We call it accounting calendar. Okay. The key goal for us to be able to look at this and periods and currency is to see how we can end up with accounting calendar. So here we have something we call calendar. What else did we look at?
The currency.
Good. So we have 3 items now here. These 3 items, the calendar, chart of accounts, and currency. Having configured these 3, and for your information, the currency we don't configure, we just enable in the system. You find it in the system, you just enable it. Enable it is like to check a checkbox. Okay. Do you understand that?
Yes.
So these 3 items, calendar, chart of accounts, and currency, with having this being configured in the system, these 2 configured and the third one enabled, we can be able to book a transaction in general ledger. General ledger responsibility. I'm not talking about any other responsibility. We have like 5 responsibility in finance. We have fixed asset, we have cash management, we have AR and AP. We are not talking about them. We are just saying that with these 3, you can be able to book a transaction in just general ledger responsibility. Are we together?
Yes.
So what happens on the others? In short, this one we can say with 3 C's. With 3 C's, you can be able to book a transaction in general ledger responsibility. So what will we do for us to be able to book a transaction in other responsibility? We have something we call accounting methods. In accounting methods, it's a feature that we have to enable or to attach and combine with these 3 other features or items to be able to book transaction in other applications.
You attach a what?
With this accounting method, we combine it with these other 3 items to be able to create or book transaction in other applications. But the process of doing this, we create something we call primary ledger. So it is through the calendar, chart of account, currency, and accounting methods we can be able to create the primary ledger. I don't know whether I am losing you in this. With these three, we can be able to create transaction only in general ledger. But there is another feature that Oracle provides of accounting methods. If we combine these three, we can be able to create primary ledger. And through the primary ledger, we can be able to book transaction in other applications.
Okay.
So what you need to know, an organization cannot work without a primary ledger, because a primary ledger is the ledger. And through this ledger, you as a functional consultant, you need to know how it is created. So it's through the combination of calendar, and it's not just calendar. We call it accounting calendar. Through accounting calendar, combining accounting calendar, we usually select, we select chart of account, we select accounting calendar, we select currency, and we select accounting methods. We can create primary ledger. And now with the primary ledger, we can be able to book transaction in AR, that is accounts receivable, accounts payable, accounts, cash management, fixed asset, and the rest. So primary ledger is very key, and that's why I had started with all this explanation to see, first of all, the importance of the date and how do we get the date. The dates, we have to get it through the calendar, and through the calendar, we'll be able to have periods, and those through periods, those accounting periods or type of periods, we can be able to open them so that we can be able to book a transaction. Then we need currency. We need to know, are we working with functional currency, foreign currency, and when do we work with, or do we implement the type of currency that it is in the system. So when you are doing configuration, you have to get to understand which currency, which is the functional currency for this client. Once you know the functional currency, you treat others as foreign currency. And also you make note of the local currency. So then the most important thing, the other important thing is how we book the transaction through chart of accounts. So the chart of accounts is made up of organization structure, segment, and segment values. And now through these three, you can be able to access them through accounts key flex field. Accounts key flex field, where is it? It is under general ledger responsibility. And it's not other than this one we are talking about here. Then after that, you get to understand accounting calendar, chart of accounts, and currency. The three of them, having configured them, you can be able to book transaction only in general ledger responsibility. But if you combined accounting methods, the four of them, you combine them, you can be able to create primary ledger. And with primary ledger, you can be able to book transaction in each and every other modules. So this approach I'm giving you as a functional consultant for you to understand, because these are the things you will be finding in client site. Like for example, I have a client who wants to set up a different ledger for the for the subsidiary, they want a different ledger for an investment department, and now they will be having the main ledger for a different ledger for the main transaction or for the main organization. So as a functional consultant, without understanding this, there's no way you'll be able to configure such kind of need or requirement from the client. So it is very important to understand the primary ledger and what makes up a primary ledger. Okay. Any question?
No, none.
You don't have any question, huh? So I would request we close for today. We will look at other things tomorrow. Are you available tomorrow?
Can I confirm tomorrow?
Yeah, it's fine.
Kindly.
It's okay, no problem. All right.
Right.
Okay, I'll share the recordings later. Okay.
Okay.
Okay. Bye-bye and have a good night.